Hello, everybody. Welcome to the quarterly market updates by the Wealth Angels, Sunny and Diego Tyra. Okay, so for today's session, we would like to cover the market updates since the past 3 months. So we are doing the quarterly basis. Today is October, almost ending the October earnings season. There's still few companies that are going to be releasing the earnings in November as well. But today we are going to cover our earnings, our inflations, and our bonds, and so on. Okay, so let's get started with the slides. We put it together. Let me know if you can see the slides, the presentation now. Okay, so calling all investors or even new investors as well, or people who want to really invest in the market, stock market, welcome today. Disclaimer. So this session is actually for entertainment purpose only and education purpose. Actually, both of us are certified or licensed advisors now at this point in time, because we have been taking recently the licenses. So we can actually talk about a lot of things about it, but we are not going to do any recommendation. You have to do your own due diligence when you're going to buy or sell or anything in between. Okay, so this is a disclaimer for this call. We also don't know about your situation, so please bear with that. During today's session, this is the agenda from the number 1, which is the introduction. We have a wonderful quote. The number 2, the main meat is going to be the topic, and call to action. Always we are going to have a call to action for you to take actions, because without action, you are not going to move the needle. If you don't move the needle, nothing is going to change. Last but not the least is going to be the Q&A sessions. Okay, Sunny?
Okay, Ophir Gottlieb, he's a pretty respected trader, investor kind of guy. He's done quite a bit of innovation in the investing world. He's been running his commentary around this meme, this particular thought. Inflation really isn't the problem with the markets. Okay. What the Fed thinks about inflation is the problem with the markets. Okay, so what we're saying here is the markets are hanging on every indication that these people on the Federal Reserve Board, especially the chairman, Jerome Powell, if they're hinting at whether or not they're going to raise interest rates to try to continue to lower inflation. And if they believe they're going to raise interest rates, then the market reacts very negatively. So the market itself can adjust to inflation. Every business can raise its prices according to inflation, and they'll continue on just as they always did. It doesn't really change the business itself. But the investors get very skittish. And so this inflation and what the Fed is trying to do about inflation has been the dominant theme that we see played out in our markets over the last 2 years. So we're going to go through first the inflation and recession updates. So we'll talk a lot about that. And then we'll do the bond yields, which people confuse that sometimes with the Fed action. So bond yields and Fed rates are different. And then Diego's going to take over and go through the major indexes and talk about how the market's actually performed, and how individual stocks have performed. There you go.
Thank you, Sunny. Yes. So today's session, Sunny is really excited, and he will over-deliver during the first 2 topics. So, Sunny, you can take it away.
It's very sad when someone gets really excited about inflation. That's really, really sad, okay? So central banks, what do central banks do? Every nation or every group of nations like the EU, they have central banks. Their job is to try to keep the economy on a certain path, right? Without getting too far out one way or another. In the United States in particular, they have 2 mandates: to keep inflation low and keep unemployment low. And it turns out, economically speaking, those 2 are actually diametrically opposed. Usually they go in opposite directions. And so it's a very, very tough job. So the question is, how well have these central banks done to try to keep the economy going pretty well, so unemployment is low, yet tame inflation? And their efforts to do this have been, like I say, the dominant theme in the markets. So in the United States, the term has been soft landing. Can we actually tame inflation without pushing the economy into a recession? So here is the actual CPI, the Consumer Price Index. This is they track the price increases of a variety of consumer goods. And as you can see, it got up in the United States to over 9% at one point. And that's way too high for an advanced economy. All right. And so the Fed started taking dramatic action, and they started doing a rapid increase in what the levers that they can control, which is they control the rate, the interest rate that they charge other banks to borrow money from the Fed. It's called the Fed funds rate or the discount rate. So they've been raising those rates dramatically to try to keep that inflation down. The theory being that if you raise interest rates, you make credit more expensive, then that cools the economy, right? There's not so much incentive to add more factory capacity or start a new business or buy a new home when interest rates are high. And so they have, then you can see the chart below it, that's the sort of the longer term thing. You can see that big spike in interest rates starting late 2020 during COVID, shot up really fast, scared the dickens out of the Federal Reserve, and they started acting very, very strongly, and you can see it's come way back down. So in the sense of that job, they've done a pretty good job. They have dramatically reduced what was a very problematic inflation. And this is just a longer term view, just to put it in perspective. That far right over there is the spike we're talking about. It's pretty big compared to the last 20 years or so, but you can see in the past, inflation had been much, much higher. That's what they wanted to avoid. That those two big peaks in inflation in the 70s and then the 80s, that was the worst period of economic peril in the United States. It was very, very tough. And so they did not want that to happen again. So they acted decisively. What you have to keep in mind is the CPI is the increase in prices. It's not the actual prices, right? So every time it's like 2% inflation, 1% inflation, that sounds really good. Prices still went up and they don't go back down. So this is the overall CPI, the actual value of it since what, 1945 or so, looks like, way back then. The cost of goods have gone from around 35 to over 300 in that time period. So things are almost 10 times more expensive than they were decades ago. So it never gets cheaper. There's a little blip in around 2008. That was during the great financial crisis. Prices went down just a little bit. And there was also a little blip during COVID. Prices went down just a little bit. And then they continued their upward climb. So inflation is a insidious, never-ending thing, right? It's always with us.
Which also means if your cash is sitting in your bank account, in the same graph is going to be the opposite direction. Okay, so it's a gain in value. Bear that in mind. Go ahead.
Yep. Okay, this is the one that the Fed has been tracking more than just the CPI, something they call the core CPI. That just takes off food and energy prices, which tend to have the most fluctuations. So now this is down to the more core things in the basket. It has dropped even faster. And so you can see that downward slope that is going on with the core CPI, that's called disinflation. So we're now in a disinflationary environment. But it's still inflationary. It's just not as inflationary as it was yesterday or the day before, right? If anything below 0%, that's called deflation. Turns out the reason that the Fed tolerate, or these central banks tolerate, a little bit of inflation is a little bit of inflation, as bad as it is over time, is better than any deflation over time. Deflationary environments are actually economically destructive. It'll actually destroy the economy. So they don't want deflation, even though I would like to see little prices come down. but it turns out economically, the incentives are perverse, and then it kind of crumbles the entire economy. So we want to keep a little bit of inflation, as little as possible, and we're trying to get it back down to that level, little as possible. Now, here's the interesting thing: commodity prices. This is the thing, the basic products that go into making other products or into food products or whatever. They're by and large in deflation. They're actually decreasing, and some of them decreasing significantly. Okay, so this is that means that the prices that go into the things that go into the economic engine are coming down, and that should eventually lead to prices overall coming down. This is sort of a leading indicator for future prices. So this is good news. That means that's one piece of good news. It shows that eventually we should get even lower inflation. And here's the overall commodity price. Again, just to give some perspective, this is a long-term graph. You can see that they've been going up pretty steadily since about 1975, with a couple of peaks and troughs. Right now, we went to a big run-up during COVID. Commodity prices went up hugely. That was part of the problem of the inflation. And now they're starting to come down. So so far, this is all good news, right? We're seeing the news that the pressures on rising prices are coming off.
Sunny, one question in the chat. They were saying why they call commodity prices.
Why what?
What is commodity? All of these are
commodity. Commodities are these things and many more. These are like the basic things that are traded without value add. All right. For example, if I sell crude oil, someone else is going to take the crude oil and refine it and make something more valuable out of it. This is the basic commodity things that are traded at the low level in the economy. So these are things that people buy, either raw natural resources or raw agricultural products, things like that. Okay. So here's the last piece of really good news. The CPI, the Consumer Price Index that everyone tracks, including the core CPI, has housing costs in it. And housing costs are actually a significant component. They're like 30 to 40% of the CPI is housing costs. And they measure that indirectly by rents. What is the average rent being paid? Well, rent, when you start a lease, you're locked in for 1 year. So even if deflation or disinflation is occurring, your rent doesn't go down for at least a year, right? So there's a 1 year lag in rent prices. So it's a very serious lagging indicator. So you can see that in this chart, about March of 22, right in the middle there, the asking rent rate had peaked up. It had gone way up, and the asking rate had peaked about then. And it started falling off. That's the red curve. It started to fall down. Last September, this last month, it was only 0.1% inflation in rent prices again. So the rate of increase in rent had really, really cooled off. And now that green line is showing the actual component of the CPI that is rent. You can see it's lagging. It's going to offset by about a year. That peak in the red line about March of 22 corresponds to the peak in the green line in March of 23, exactly 1 year later. So now as rents start, this big drop off in the inflation of rent starts showing up in the CPI, that's also going to drive our inflation measure, our CPI, further down. So commodity prices are coming down, rent is coming down. Okay, so all these are going to continue to lower the CPI. All good news, especially for us consumers, but also for the markets. Okay. All right, so this is where we are in terms of inflation. And like I said, the quote said, it doesn't matter. Inflation doesn't really make that much difference to the markets. It adjusts. But what the Fed thinks about inflation really impacts the markets. And it's through various means, which we'll talk about a little later. Right now, the markets are worried about another rate hike. Not so worried about November. They're pretty much sure they're not going to raise it in November. But then there's still some doubt about what's going to happen next 6 months or so. So there are two things that actually are impacting these decisions. One is the Fed, right? And don't confuse the Federal Reserve with the Treasury. In the United States, those are two distinctly separate things, and in most countries, they're two distinctly separate things. So the Federal Reserve, like I say, it sets interest rates, that it sets the rates that banks can borrow at. So if a bank can borrow at 4%, then they're going to turn around and make loans to you at 6 or 7% to make a profit off of that. So that's driving up borrowing costs, and that's how they cool the economy. But the Fed doesn't set the rates for bonds. Right? For Treasury bonds in particular, the ones issued by the United States Treasury or treasuries around the world, those are generally set at auction. So people show up, they say, I'd like to loan the United States some money. I'm going to buy a bond, loan the United States some money. And they say, but I'm only going to settle for X%. I'm going to wait. So they start off at auction. Okay, do anybody want to take a bond at 3.5%? Okay, 3.7%, 3.8%, 3.9%. Okay, yes, I'll do it at 3.9. So it's sold at an auction. And so right now, the buyers of bonds determine the rates of the bonds. It's very important. It's not determined by the government. It's determined by the market, what the market or the buyers of bonds are willing to pay. And so right now, that has been gone up really fast, faster than the Fed raised interest rates. So the yields on these Treasury bonds have really shot up very fast. And that wasn't under control of the Federal Reserve. So there's two separate effects going on here. Let's go on to the next slide. So how do bond yields affect the stock market? Okay, like I say, we told you earlier that inflation really doesn't affect the stock market very much, but what the Fed is doing really affects the stock market. So it's a secondary effect, right? Bond yields have a direct effect on the stock. And there's three ways it does it, right? Recently, the bond yields in the United States for the benchmark, that's sort of the ones everyone compares to, the 10-year Treasury reached about 5%. So when you get that high, you start attracting money out of the stock market into bonds. They say, well, if I can get a guaranteed 5% for the next 10 years, I'm good with that. Why should I put my money in the stock market? And so people start selling some stock to buy bonds. So selling stock drives down the stock market prices. Okay. Second effect, there's the way that sophisticated, I'm going to put in air quotes here, sophisticated investors calculate what a company is worth so they can determine what stock price should be that they're willing to pay for it, is heavily dependent on the current bond yield. It's called the risk-free rate. And there's a calculation they use called a discounted cash flow that investors around the world have been taught. This is how we evaluate how much a business should be, how much we should pay for a business in the stock market. Well, when the rates go up, the valuations go down. And so they say, oh, wait, suddenly all these stocks look overvalued. The business hasn't changed. Business is chugged along just like it was yesterday. But when those yields go up on bonds, suddenly the calculation says they're worth less. It's a little complicated, but the point is, that's another way bond yields affect stock prices. The more sophisticated investors out there suddenly think that their stocks are overvalued, and they sell them. Third thing, high Treasury yields impact, it's not just the Fed that impacts the banks. The banks hold bonds to cover their deposits. Okay, so those are typically long-term loans like car loans or especially mortgages. So the higher the bond yields, the higher the cost of consumer debt. Right? So especially the longer term consumer, not credit card debt necessarily. That's more sensitive to the Federal Reserve. But long-term debt, like a mortgage, a 30-year mortgage, is very dependent upon what the current bond yields are. So now we're seeing mortgage rates spike up to 7-8% here in the United States, or even higher, which makes housing prohibitively expensive. So people aren't buying houses, right? Car loans are also, even higher than 7-8% in some cases. So people they're postponing buying a new car. So that's impacting the economy, threatening to tip the economy into a recession, right? And the stock market is always forward-looking, and it says, oh my gosh, this is dangerous. We could be heading into a recession. I'm going to sell my stocks. And so those three ways that these high bond yields are negatively impacting the stock market. Okay, that was a little wonky. Did everybody follow with me so far? All right, close enough. All right, this is just showing how fast those bond yields. This is just since August, right? This is a very short-term chart, but that is if you know how bonds work, it doesn't matter if you do or not, but I will tell you that is an unprecedentedly sharp rise in bond yields. And that's what has really spooked the market over the last several months. Okay, the last thing I'm going to turn this back over. There's a hobby among economists to predict what the Fed is going to do. They're going to raise rates again. They're going to raise rates again. Are they going to raise rates again? They're all worried about that, right? And so for this month, the November meeting, everyone pretty much thinks today that there's a 0% chance that they're not going to raise rates. A month ago, there was a 23% chance, they believe, on average. For December, now they still think there's a 20% chance, but that's still down from a month ago. They thought that would be a 42% chance. And then for January, there's today a prevailing around, they say it's about 30% chance they'll raise the rates. But a month ago, they thought that was a 45. So what we're seeing here is across the board looking forward, these people who make it their business to think they can predict what the Fed is going to do are pretty sure the Fed is less likely to raise rates. And the reason the Fed is less likely to raise rates is, one, we can see inflation is already being tamed and will continue to be tamed by these things that they're factoring into that inflation calculation. And now they're seeing the bond yields have risen so much out of their control, right? Not in control of the Fed. It's helping them tame inflation, and it's almost too much, right? It's almost tipping us into recession. The worry now is not so much inflation as, are we going to go too far and tip us into recession? So the probabilities of another Fed hike seem to be lower. Okay, last thing, this is sort of segue. The mutual fund industry tracks inflows and outflows of funds to its mutual funds as in aggregate and overall. Okay, and if you look there, this is several weeks back, there's been billions and billions of dollars every week flowing out of mutual funds. I mean, people are selling their mutual funds and going to cash, selling the mutual funds and going to cash, and that's across both stock and bond mutual funds. The reason why they're selling bond mutual funds is the less obvious. Stock up. Why they're selling stock is pretty obvious. And we won't go into why they're selling bonds, but they're selling bond mutual funds as well. Okay. So that's money is flowing out and it's going somewhere. It's going into money market funds. So this graph is kind of hazy because it's kind of divided up too finely, but you can see that the amount of money in money market funds is going up. Money market funds are often, when you set up a brokerage account and you put cash in it, one of the options is it can go into a money market fund. And it gives you some interest rate while your cash is sitting in your brokerage account waiting for you to invest it elsewhere. Right now, a lot of money is going into those money market funds. And they're yielding pretty good. That's why it's staying there. It's getting decent, better than your bank savings account kind of yields. And so the money is kind of staying in these money market mutual funds and coming out of equity and bond funds. And money markets, it's a sort of a cash-like kind of thing. Okay.
Great.
And now, what's it done to the market, Diego?
Wow, what a session. Everybody, how do you feel about it? I think Sunny was really excited to share all of this stuff we were talking about before doing the session, but I think go all for it. So I hope you understand it. It's a bit fast-paced, but this is the information you might need to know in order to understand how this economy is actually moving or working. So I'm going to cover the major index year-to-date results. So year-to-date, we are in October, almost the end. And this is the market hit. Okay, so this is kind of the companies, the S&P 500, actually divided by these three different companies, which is the SPDR, iShares, or Vanguard. It's totally the same. They are trying to replicate the S&P 500s. Okay, and you can see here 6.84%, 6.85%, 6.83%. So it's almost there, almost the same, but they are trying to replicate the S&P 500. Okay. Here, which is a big winner, is Nasdaq. So they are focusing more in the technology companies. So the technology company actually starting to do very, very well since last year end or this year beginning, and they are hitting around 28%. And in the right hand side, you can actually see there are many different indexes, but you can see here as well the fixed income on bonds that are not really performing well, especially TLT, which is a 20 years treasury bond. And if you see the 17% down, this is really kind of since 2007 is the lowest in the history almost after 15-16 years. So those people who actually putting the money into the funds or bond funds is actually bleeding, losing money. So don't think that bonds, because our bonds are secure, because the yield is going, because this price is going down, the yield looks very attractive. But the thing is, the price of this TLT can go as low as 17% down. Okay, so comparing with the indexes, take a look at the individual stocks, right? Year to date, you will see here in the left-hand side, based on the market cap as well, there are big. The technology company are the biggest, among the biggest. Microsoft around 35% up this year. Google is also 36% up, even after the drop, after the earnings drop. Meta, wow, it's a big winner, which is 141%. Nvidia, I think this is the stock or the company of the year, 172% up, Apple 29%, and so on, right? So you will see a huge difference towards comparing with the basket, right? This you invest in the whole school or the basket of 500 companies, you expect to have the average, right? Even you have a big performance inside there, making this much, you will still having 6%, 6.83%. So when you put it peer to peer, indexes versus individual businesses, in this third quarter, the actual result was, okay, China is really down. Then the Dow Jones is a little bit down, 2% down. Year to date, S&P 500 in the middle, which is 6.84%. The Russell's 1000 is around 15% up, and Nasdaq is 28%, right? Compare with the manga stocks, which is a little bit different. Manga, starting from Meta, 141, Amazon, 49%, Netflix, 33, Google, 36, and Apple, 29%. So you will see the difference, right? Here, it's more or less Nasdaq, which including all of these stocks. And one update that we can proudly say, which we started investing in the Wealth Angels paper portfolio with all the members. We are achieving 32.55%, which is beating all these indexes and 5 times more than the S&P 500. So if you know how to pick the right business, right, based on the right matrix, you will be able to outperform the market by force. Another thing that we always share with you, right? 6 months ago, April 27, when we did updates, it was around the grids section, the fear and greed index. Okay, prior updates, it was around the grids. So when it's coming to the extreme greed or greed, we actually don't want to really touch or start buying, right? That is the time that to hold or even sell if it's extremely high or if it's very expensive, right? The market is expensive. So now, what is it now based on October 2023? Where do you think it is? Can you put it in the chat? Or how do you feel it is? It's in the neutral, fear, greed, or extreme fear. I want to see in the chat. Fear, okay. Extreme fear, okay. Fear, 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 okay. So more or less everybody is saying around this or neutral. Okay. Let's take a look. Yes, it's entering the extreme fear right now. Okay, so which is for us long-term investor. We are not trading here. We are long-term perspective, which is minimum 5 years. If it's possible, 10, 20, or as Sunny will say, never, forever, right? This is the same for Sunny. And the extreme fear, we are going to enter a little more around there. But the thing is, as you can see in the fear and greed index, right, versus the S&P 500, is really moving alike, right? And in the previous session, that it was around April, around here, and the fear was extreme as well. We were not suggesting, but we're saying it's a good timing to actually start this journey as an investor, right? Why? Because everybody, when they're selling, panic selling, or talking about the crisis is going to come, what we are going to do as a sophisticated investor, do the opposite. But the thing is, if you are investing in the S&P or index funds, I believe that dollar cost average is the best strategy for you, right? You don't need to time the market. You don't need to follow any news or whatever. You just only keep buying every single month, right? That is the best you can do. You don't even need to care about the ups and downs. But if you are investing in the individual companies, that is a bit different because they have intrinsic value. They might be overvalued. They might be undervalued. So if you don't understand how to analyze that, better learn it first. Okay. Sunny, do you want to cover this one? I think
Sure.
you have something to say.
I mentioned earlier that a lot of money was flowing out of mutual funds, which, by the way, we're not recommending mutual funds, but it's something they track. So money is moving out of mutual funds and into money market funds. Well, there's like the fear and greed index, which is sort of a measure of market psychology, right? It's saying, hey, people are fearful now because the market's gone down, or people are greedy now because the market's gone up. It's sort of a lagging indicator where the market's going to go, right? So is this. This is called the potential growth indicator. That means what percentage of the money that's actually invested in the markets, in stocks, is on the sidelines of mutual funds, or sorry, money market funds. So right now, about 13% of the total amount that's invested in stocks is actually sitting on the sidelines. That's very high. There's a lot of money sitting on the sidelines for a variety of reasons. But that's potential money that can flow into the market and fuel a stock market rally. So that's what we're looking at here. How much dry powder do people have? How much money is sitting there waiting to be deployed should the market start going up? And they'll start, as the markets go up, people start being more willing to invest again. They get greedier. That fear and greed index goes higher and higher towards the greed side as people say, hey, the market's going up, I'm going to jump on that. So this indicator says right now we're in the green over here, 13.14, saying that's kind of maybe time to think about, we should be thinking about buying stocks instead of selling stocks. Just like the fear and greed indicator says, when everyone's really fearful, extremely fearful, that's usually says that there's a lot of bargains out there in the stock market. People have been overselling stocks. This is another confirmation of that, looking at this ratio between money in the market versus money in these money market funds. So both of those are saying right now, it's starting to look like this might be a good time for investors to start thinking about looking for bargains in the stock market.
Thank you, Sunny. Yes, so there is always some indicator you have to follow. And most of the people also follow the PE ratio. And if the PE ratio of the S&P 500 is actually around 20 or below, it's kind of undervalued. If it's more than 25, 30, 35, that is starting to become very, very expensive. So if you see as a holistic view, right, based on the index, then you can take a look at the PE ratio. Nowadays, it's actually in between the 5 years and 10 years low average. So it's not really expensive. It's not really cheap, but it's kind of the fair value of the S&P 500, or even it's starting to get in lower and lower because many reasons that is happening that we are going to share in the summary. And one more thing is the annual seasonality that we have been covered since last year around this season as well, because the market tends to have different patterns and show based on historical data that will show how good or how bad the market tends to perform over the years, right? So when you connect the dots, it's look like this. And this is the S&P 500 right now, the 2023 year. And when the S&P 500 is up around 10 or more in the first half, this is how it tends to perform. And that is statistically, right? We can never predict the future, could possibly happen or not, okay? But it's saying that in this period of time after November, what is going to happen is the Santa Claus rally, or before the rally or the year end, is going to actually pick up. We are not predicting, this is statistically what happened in the past several decades, okay? And also there might be possible, what could be discussed, so possible downturns, adding on, or what also Sunny was mentioning, could be the war with Israel that is getting worse and worse over the days, as well as the tax loss harvesting. If you know what it is, in US, actually, the mutual funds, especially, they want to sell the stock or the position they have at losses, so you can decrease the amount of taxes you're going to pay, right? And then after you sell, then they will going to buy back later on, maybe after 1 or 2 months, and pick up from there. So the thing is, the deadline for the mutual funds to actually sell this position is 31st of October. So there is another 2 more days to go. It might be going sideways or down, but after that, it could be possibly these things happen. We are not predicting, but this is how we see as of now. Yeah. Okay.
So predicting the future in the stock market is impossible, but we can read the tea leaves and then maybe check out some chicken intros and then possibly do some tarot cards or whatever. These are different indicators about what the future might hold for us, looking at these different things. So we take a broader view. It looks like things are aligning better than other times, but it doesn't guarantee anything, right? But it does look like, hey, stock price, the market's in extreme fear right now. There's a lot of money on the sidelines. Inflation seems to be coming down, right? And historically, there's this data that says when the market's up 10% in the first half, it generally finishes very strong. So all those are kind of leaning us that maybe this is not a bad time for as investors to think about getting into the markets. All right, so here's the conclusions. Inflation does seem to be tamed. The indicators are that inflation has been effectively curtailed in the United States by the action of the Federal Reserve. So the core CPI is declining. It looks like it's going to continue to decline, especially as that lag in rent starts showing up more and more in the CPI. Commodities are actually in deflation. The thing that the Fed didn't expect is this sudden surge in Treasury yields. That helps the Fed in their mission to curb inflation. But that wasn't part of their calculations, right? So they're trying to readjust to what this is going to do to the markets, right? And trying to get that soft landing. They don't want a recession. The Fed's trying to do this balancing act where they reduce inflation without going to recession. So now they're trying to figure this out. And by the way, despite sometimes these guys get on these speeches and everyone listens to every word, every nuanced inflection of every word that these guys say that are a part of the Federal Reserve Board. And so sometimes they're saying things that's what's called hawkish. That means they're implying that there may be more rate increases in the future. That scares the market to death. a little word here and there by a Federal Reserve guy, and the market goes down. It's like people are just terrified this is going to happen again. But even despite that, most people are saying, hey, we're not going to have a rate hike this month, and it's less and less likely even in the future. And for now, we're not in a recession. Matter of fact, the economy is incredibly strong. The economic growth was 4.9% annualized as of the last report. That's way above expectations. Inflation is going down faster than the Fed thought it would. Unemployment has not gone up. We have very, very low rates of unemployment. It means the economy is still very strong. And wage growth has not increased as much as one might expect, because when the unemployment is low, typically employers have to raise wages to attract workers. That hasn't really happened that much. All right, that means there's no wage push inflation. When workers get more money in pocket, they spend more, and that can be another contributor to inflation. That hasn't happened. So again, things are looking really strong towards a soft landing, that we might actually get out of this with low inflation and a strong economy.
Yes, and other to add on here, the economy growth, I mean, the S&P 500 companies actually reported a year-on-year growth in their earnings for the first, I think, since Q3 2022. So that company is actually also picking up a lot, right? And 8 sectors are reporting the growth, like communication, consumer, discretionary, technology company, even financials. The 3 sectors that are actually reporting decline is energy, materials, and healthcare. Okay, so but the thing is, everything seems to be okay. And the negative news that we already mentioned there, I think is already out as priced in. So we are kind of continuously being positive when everybody is in the chaotic mode. So let's get to the call to action. Let me go for it. The call to action will be, as always, when market downturns are the time of a great uncertainty, when everybody is freaking out, everybody is panic selling, everybody is putting the money in something very, very safe, right? And yeah, fear. But we have this age, we have opportunities here, right? When that happens, we need to put the other head that we are going to be greedy when others are fearful, right? And keep your heads and keep investing as well. So the thing is continuously doing what you are doing right now, collecting great business at undervalued price. Maybe if you know a bit about technical analysis at the support level, when it tends to come back again, and buying in tranches, which is not going all in once, but buying in tranches at certain points. Okay, so if you can continue doing that, and yeah, you'll be going to do very well in the long term. Yes. So here it is. If you want to continue the journey, we have the invitation to you. We are doing this with the Wealth Angels community. We are coming back and doing this research of the companies that are going to invest in the paper account. We get to know, okay, when is the next tranches to add in? We do every single quarter or 3 months, we need to go back and check, how the company is doing, and then get the right price if we are able to enter or not, if it's way undervalued or not, right? So this is how we combine all the people specialty as well as the work together, because if you are alone, that would take a lot of time to analyze one stock or one company. But if you're doing together, you can go far and faster.
What we're trying to do in this premium community is we're trying to build on a community. We're trying to get to the point where we know one another, we can rely on one another's expertise, and we learn how to analyze companies on our own. We don't rely on some other guru to tell us to buy this or sell that. That's not what we're trying to teach you to do, and that's not what we're doing. We're not going to tell you, buy this, sell that. We're going to teach you how to determine that for yourself. So that interests you, doing that in a community with other people learning alongside of you and helping each other out. is a very, very powerful way of doing that. So we'd invite you to do it. We also have our Mastering Money community, which is for those who are just on the journey to get control of your personal finances. You're not yet ready to invest. That community is free. We encourage you to join it. It's based upon what we call the Financial Freedom Fundamental Series. Come join that. We discuss how we can move the needle to get your personal finances where they ought to be. And so you are ready to become an investor. And then when you are ready to make that step and you want to learn and you want to invest in businesses, stocks, we encourage you to join our premium community where we teach you exactly how to do that. So we'd love to see you there. Any questions anybody have? Any comments? And as always, I'll allow one nasty remark, just one. So it was a little bit wonky. I do apologize for it, but the reason I went so deep into the inflationary things and the root causes of inflations and the bond yields is because that's exactly what's driving the market. All right. We know how to evaluate businesses, and the market people know how to evaluate businesses, but yet the market is forward-looking. All right, and so they're taking into account what are these things going to do in the future to the stock market. And so we're trying to show you what's driving the stock market. And recently, the stock market's been in a pretty serious decline since its recent high, and that corresponds almost exactly with that massive rise in bond yields and also the rate cuts by the Fed. So this is why. It's always good to kind of know why.
So if you have any questions, just raise your virtual hands and then unmute yourself. You can check live. I think it's the best way to ask questions here. If we haven't replied any question you put in the chat, just ask directly. That is the best way. Yeah. I hope you enjoy the session, and we try to do it at 45 minutes mark, but we can never end that fast. Sorry about that. But today, yes, Sunny was over-delivering. I was delivering behind the scene in the chat. So yes, Britt, come and ask your question.
Hi, thank you guys for doing this. I have a question on, you had talked about on another one about diversification, having too many things. And so I'm not sure. So I had bought the S&P 500 as an index, but then Fidelity came out with these like 0 expense ratio, but you had to buy the emerging stock. Like it wasn't the whole S&P 500, so it was the chunks, but it was a 0 expense ratio. So then I bought the different chunks just to see how that would go. So now I basically have the S&P 500. I also have the total stock market, and now I have the emerging, so I've got all the same stuff. Is it smarter that I just sell some stuff and dollar cost average what I can and just get it into one thing? Or does it not really matter, and do I leave it the way it is?
I would say that your total stock market ETF doesn't buy you anything that you don't have in all the other ETFs. So that one is it's redundant, in my opinion. Right? The S&P 500, even though it's only the 500 largest capitalized companies in the United States, in essence, the rest of the market is very small compared to that. All right. So if you buy the S&P 500, the rest of the market really doesn't move it very much. So that's one thing. The other thing, buying, I think you said emerging, what would you say, emerging growth? Is that what you said?
It was, I can't remember now. They had it chunked up. Basically, it was the entire stock market. They had a value, a blend, a growth. It was basically each piece you could buy separately for a 0 expense ratio, but you couldn't just buy the whole thing.
Okay. Are those ETFs or are those mutual funds?
They're index funds.
Index funds. Okay.
They're the Fidelity 0 ETF index funds.
Okay. Let's put it this way: it doesn't sound like they're actually tracking indexes unless they made their own. Then they're tracking their own index, which is fine.
Okay.
Yeah, I can't advise you very much. Let me just say that in general, in the past, the people who analyze the market as a broad thing, they divide it by capitalization. They look at small cap, they look at mid cap, and then they look at large cap. All right. Well, the S&P 500 is dominated by the large cap, but it goes down through mid cap. Right. But the mid caps don't move the needle very much compared to the really giants in the fund. All right. So if you want to get more exposure to what's going on in that mid cap range, then you would buy a mid cap ETF. That's fine. If you get more exposure at the very bottom of the range, which is not covered by the S&P 500, the small cap, then you would buy a small cap ETF, and that's fine too. So I have no problem with that kind of diversification. That's you're just exposing yourself to the different size companies in the market. And it's sort of an arbitrary thing, right? Oh, we're big companies, medium-sized companies, small companies. Does that really matter? Well, they do behave differently at different times in the market cycle. That's why it's not a bad idea to have the big companies, S&P 500, maybe a little more emphasis on the mid caps, which historically, by the way, have performed better than either extreme, okay, or the small caps. I don't have a problem with that. If you're doing ETFs, that's actually a pretty good way of diversifying across the entire economy.
Is it smart to actually sit down and is it smart to sit down and look at the holdings and the ones that match up, just kind of sell one and put it in the other?
Yeah,
just sit down.
Certainly you'll see a lot of overlap between the total market and everything else, right? So that's kind of redundant. You'll see some overlap between the mid cap and the S&P 500, right? But the difference is the S&P 500, the mid cap companies in the S&P 500, the way that index is weighted, they don't have much impact on it. It's totally dominated by the large 7 or 8, 10 companies at the top. The Apples, the Amazons, the Nvidias, those move the S&P 500. And if a smaller mid-sized company that's in the index has a great move, the index won't even notice. It's too small to make an impact. So if you want to see how those mid-cap companies' movements will impact your portfolio, then the mid-cap ETF would help you do that.
Okay.
Right.
And with the way the world's becoming more global, I used to have a chunk international and a chunk domestic, but now, I mean, Apple's everywhere, Google's everywhere. So I'm feeling like there's less importance to have international. It tends to perform not as well. I just had it for diversification. Would you say keep international or?
Yes, I mean, it's not wrong because generally today, it used to be the markets around the world were not well correlated. That means if the US market was up, maybe the emerging market was down and vice versa, right? They weren't that correlated. And still the so-called emerging markets don't correlate well with anywhere else. They go to they march their own drum, okay? But like Europe, Asia, especially the developed economies outside of China and Asia, and the United States markets, they tend to kind of go now in parallel, right? There's not a lot of there's a lot of correlation between those markets. The old saying in the United States was in the 50s, because General Motors was such a large part of the economy, was if General Motors sneezed, the economy got a cold. Right? Now this saying is if the United States market sneezes, the rest of the world gets a cold, because it's such a large component of the world stock market. Good, bad, indifferent, that's just the fact. That's how it's emerged. Okay. So if you want to have international exposure, I'm all for it. But understand that there's a high correlation now so that idea of diversification is less important unless you're talking about emerging markets. So
yeah, I have some emerging.
Okay, that might be something if you want to kind of get a little bit of non-correlation into your portfolio.
Okay. Thank you. Thank you both. I appreciate it.
Mexico gets pneumonia.
But by the way, I think this one I was trying to check. This is the one you mentioned, right? Fidelity Zero Total Market Index. Is this the one?
Oh, I didn't do their total market. I did. They had like 4 of them.
Okay.
But it's the zero. It's a 0 expense ratio. I only went for it because there was no fees. And I bought it like 2 years ago. I was just curious because it doesn't match exactly when I printed out the like funds. They have fewer funds that they're managing, but it was it was their advertising 0 expense ratios. So
Okay, then check where is the cost actually included, how they make the money, and if
When I asked how they make their money, they said it's a marketing tool to get people to bring their money to them and then buy other stuff. So they said they technically, these are giveaways to try to get people to bring money. And then once they get familiar with the Fidelity platform, the idea is they invest in other things that give them money. But their pitch to me was, on these couple of the ones they have, you're just getting them totally free. So
keep in mind that almost any index ETF, the expense ratio is minute. Because they don't have to do anything. They buy the index and that's it, right?
Right.
So your expense ratios are usually like 0.1%, 0.05. They're already so tiny. So yeah, I'm always sensitive to expenses, but in this case, what you're getting is it's a little bit of advantage, but it's a very, very small advantage. So if you think that those are perform well enough to anyway, that's great. If you think you can do better elsewhere, then I wouldn't worry too much about that little bit of a discount. Okay, because almost all ETFs have a very, very low expense ratio.
Okay, thank you.
Yeah.
Hey, thank you for the call. I learned a lot. I have a question. When you invest on commodities, is there like a best way to do it, or a brokerage that you will recommend? I'm in the US, but for commodities here, I feel like I hear a lot about futures, but I don't know if there's a better way or easy.
Honestly, I'm not interested, nor do I have ever invested in commodities. So for me to give you advice would not be. I don't have any good advice for you. You would probably want to hook up with someone who is an experienced commodity trader to get the advice from them, and I am not. I'm sorry. So
That's okay. Thank you.
I am in the same picture as Sunny, so I'm not interested in the commodity as well. But most of the platform, actually, you can invest in this kind of commodity. Some of them, you need to make sure that you can invest in futures, options, on all of this stuff. But if you are new investor, I highly recommend not to invest in future options or all of this stuff, which is high leverage. You have to know really well what you're doing, because you can lose everything. Okay, and commodities, yes, I think you need to search for the ticker symbol, and you can buy any commodity up there in the market, like gold, silver, or whatever commodity using the platforms. But the easy way is Google, put what is the best platform that I can buy commodities, and they will give you the top 5, the top 10, depending on where you are in your country. And then read the comments, read the suggestions of the people, and then you can enter or open an account that you can do that in your country, okay? Or ask somebody else who are actually doing it.
I think this is a good time to comment on why both Diego and I, we didn't know each other until a few years ago, but we both chose investing in stocks as our way to generate wealth. The reason is a stock represents a share of ownership in a business, right? People doing things and creating economic value. You can actually at least roughly assign some value to a business, right? It has some natural intrinsic value, and so you can buy shares in something that actually has value. What is the value of a coffee bean? It depends on what people are willing to pay for. Right? What's the value of a barrel of oil? It depends on what people are willing to pay for it. What's the value of a Bitcoin? It depends on what people are willing to pay for. So these kind of markets are supply and demand markets. You're betting on the future price movement of something that in itself has no intrinsic value, right? Oil has no intrinsic value. It's just a substance in the ground. The value of it depends on what people are being willing to pay for it. Amazon, however, has intrinsic value. It's an organization generating economic gains. So I never trade in things that are supply and demand trades. Okay, that is, the stock market in the short term, by the way, is supply and demand. That's why you see all these wiggles and fear and greed and all this kind of stuff. That's supply and demand for individual stocks. But in the long term, that's why we talk about long-term investing in stocks. The stock market reflects very accurately the successful businesses and weeds them away from the unsuccessful businesses. So I would caution you against investing as a beginner in anything that's simply a supply and demand market, because you're trying to predict it's called the greater fool theory. You want to buy it at this price, and your hope is a greater fool is going to buy it from you at a higher price, right? And there's no way of knowing whether the price you're paying is worth anything. You're just hoping that someone else is going to pay you more. Now, you can make some predictions in commodity markets based upon world economic trends and this and that. So it's got a little bit of grounding compared to other kind of markets. But honestly, there are better ways that you can invest, that you can have a lot more certainty about what's a good investment and what's just speculation. Okay, so I would just caution you about it. Not going to tell you can't do it. Many people do. All right, but I would caution you. So, Gregory.
Yes, I was doubting to ask this question because I'm very, very, very new. And what I do now is I just give every month, or I say to the bank, this is the amount of money I want to invest every month. I started with a very defensive profile. Now I'm at a dynamic profile, but I really don't follow it. So can I follow it, what the bank is doing? Should I follow what the bank is doing? Can I do something by myself? Can I combine it, the bank and me? What is your recommendation for a rookie?
So whose money is it?
Mine.
So should you follow your money?
Yes, but as I said in the beginning, I really don't have an idea of investing, and that's why I joined this community. But I'm really, or do you recommend me to follow first the basics of investing and then, step by step go from there?
So again, I've said this every meeting, and Diego will echo this, I'm sure. When you give someone else your money to invest on your behalf, their interest is in their interest. So they're going to make money off of your, right? Guaranteed. The only person who's guaranteed to make money is the person you're paying to manage your money. Okay. They're guaranteed to make money. That's the way their fee structures are set up. All right. Will you make money? Well, it depends on their expertise. So yes, so you're at a point where you realize you want to invest. You're relying upon someone else to invest it for you. And so first of all, yes, you should be asking a lot of questions and tracking what they're doing with your money. That's one way you can learn. Right? Second is you need to start learning on your own how you can eventually fire your advisor and start taking on that responsibility yourself. And that is not as hard as the world wants you to believe it is. The financial industry, the worst thing that can happen to the financial industry is people start learning to do this on their own. Because then the financial industry collapses. They have no more income, right? They make a lot of money off of people who think they can't do it themselves. A lot of money, huge amounts of money off of people who just simply don't have confidence they can do this themselves. But the truth is you can do this yourself. All right, we just got to learn how. You just have to learn how. All right, so take the time now and start learning more and more until you get enough confidence that you're ready to say, hey, thanks for your help these past few years. I'll take that on myself now. I can do a lot better than you. And you can do a lot better than it. So that's my advice to you. You learn, ask questions. Don't let them just blindly trade your account, do whatever they're doing. Don't let that happen, because every time they make a trade, they're making money.
Yeah.
All right. So
okay,
ask questions, to make them explain to you what they're doing and why they're doing it. So at least give them make them a little bit uncomfortable. That's okay. Right. Yeah. And then learn from what they're doing that works and what doesn't work as you're learning the nuts and bolts of how to do this for yourselves, and then take it over. Be my advice.
Yeah. Okay. Thank you.
Okay.
Yeah. So I will echo that for sure. Is after all, it's our money. We need to do some. You might want to start learning first, not taking the money. I will handle it from now on, but you can start small and then start learning. And then when you see that you can do it and you are performing the banks, right? You will see, oh, actually, I should take over everything. So gradually, you are starting your journey, learn, gather with us as well around this community, because everybody is aiming to do something about it. It's not like, okay, I don't know, it's okay. But the thing is, after 20 years from now, when you want to retire, you open your bank account, you open your retirement account, will you be okay? Might be a bit late. So what you can do now is start doing something, which is learning. And it's like the gym, going to the gym. You're going to start little by little, and then you're going to get stronger and stronger, right? And the financial is the same. Investing is also the same. Just only following through the path well known and going towards the end. And you will be able to be comfortable with it, because you're going to be in control. You feel in control, and you will be able to take the decision by your own. And when you talk with the banks, you are going to ask better questions. You are making them more uncomfortable. They can give you the information. Yes, it's good market information that you might not be able to get from them, but at the end of the day, you have to make the decision. And I can tell you this because after we went through all these ups and down journey, trying to use them, I tried to use them, but I fired them because I was doing way better. Then now, actually, we took the license to become this kind of advisory. We are licensed right now, and then myself, I'm trying to go into this industry to get to know what I can see. And it's all naked to me right now. So I can tell you, whatever you're paying right now is not cheap. Whatever you can save by increasing your knowledge is tremendous. So if you are having time to actually put it into the OT, overtime working, then save the 30 minutes, maybe weekly basis, time box to read a book about investment, a book about attending this course as well, and doing your planning and strategizing. That is going to save you and increase your wealth over the years. So work a little bit less and then study a little bit more in this category. That is my advice.
So yeah, Diego and I both could say, hey, don't worry about it. You give us your money, we'll invest it for you, because we can. We're fully legally able to do that. But we're not telling you to do that, are we?
No.
When I was studying for this exam that certified me to be able to do this, 90% of the exam was about how I can legally make money off of you. It wasn't about how to best invest or how to do this or that. It was, how can I legally extract money from my clients? That's what you're facing here. That's the industry you're going in, that's trying to attract you in here. Okay. So just beware that industry won't exist unless they have clients. And the only reason they have clients is they convince you that you're too stupid or this is too hard, right, for you to do it yourself. And that's just not true. Learn how.
Yeah, that's why I lost thousands of dollars.
Well, I mean, like I say, short term, you can see your account go down, even if you're an expert investor, and because the market will do what the market's going to do, right? You can't fight the market. There are times when the market's going to go down and your account's going to go down too, even if you're the world's best investor, like Warren Buffett or somebody like that, right? You will still see your accounts go down. And it's not permanent unless you sell. That's when you lock in your losses, right? So if it's just paper loss for now, it's fine. As long as you have the longer term perspective, and that's because in the stock market, that is the key. That is your advantage as an individual investor that the institutions cannot use. Long-term investing.
Yeah.
They're focused on making some report or something for the next 3 months. And so they're going to do things motivated by a whole different time perspective that's not healthy as an investor. All right.
Mm.
So that's a long-term perspective. Learn how to do it yourself. You can do this. You got it, Greg. You're going to do fine.
Yeah, thanks. All right.
Trina, hello.
Morning. Hey, I just had a quick question about something Diego said about mutual funds and some October 31st cutoff. I've never heard that before. So if you sell at a loss, it needs to be done by the end of October.
that is the tax loss harvesting. So
Oh, I didn't know that was a thing.
yeah, tax loss harvesting. So you can Wikipedia, that is everything on that side is going to be there. And
It was the end of the year.
but the mutual fund is actually needs to do it. The cutover is 31st of this month.
Oh,
Well, what they do is there's also something called window dressing, and both are going on. One is they'll sell their losing stocks to hedge against capital gains, tax loss harvesting. And they want to sell their losers. So when they publish their quarterly report, they only have winners.
oh,
Holders all look like winners, right? And so that's called window dressing. So you will
Right.
see at the end of each quarter this activity. The tax loss harvesting, Carol points out, it's really only necessary at the end of the year, December 3rd. Before the end of the year, you need to, then you can count those losses against your gains and whatnot. So you'll see a lot more tax loss harvesting the next quarter, because they want to catch up on that as much as possible. But generally, every quarter, they're pretty much trimming off the losers just because they want to look good, their brochures look better, their holdings look better, and they can sell more mutual funds. Okay, so that's called window dressing, and in addition, it's also called some of that is motivated by tax loss harvesting. So there's two motivations there.
yeah. My other question was with the NASDAQ versus the S&P 500. I'm not sure why, but it seems like on all the 401k plans and stuff that my husband and I have had our options, or, they'll give you like 12 different things you can select. I feel like I've never seen the NASDAQ listed, because I was just thinking, gosh, it looks like it's doing significantly better than the S&P 500. Maybe I should have had some money in that. But it's like
yeah.
there's not even choices for that. So I'm going to log on today and look.
Yeah. Well, there's rarely a NASDAQ 100 mutual fund. Typically what you have in retirement accounts are mutual funds most of the time. There might be ETFs, but mostly it's mutual funds. It could be index mutual funds, but they're mutual funds. And so there's I don't know of any QQQ or a NASDAQ 100 mutual funds.
Right. So
and
in what you described, I have the S&P 500 index fund, or it's an ETF, and then two other, like the small cap and the mid cap.
Yep, there you go. That's fine.
But it would have been nice looking back. Like, I wonder why they don't have an ETF for the NASDAQ, or maybe they do, and I never noticed.
And if they really don't, call your HR department and say, you need to talk to our 401k plan administrator. We need a QQQ index fund.
Right. Okay.
Ask for it. You never know.
Okay, so let me share one thing. You can check upon the internet, and no, this is not this one. Can you see the
We see your Fidelity zero income. Is that what you're...
Oh, okay. No, this one then. Okay.
There.
Can you see that? Okay. For most mutual funds, the deadline sales is October 31st. While retail investors have until December 31st. So there is a difference. Yeah.
Yeah. I'm not a big fan of mutual funds. I try to ignore them as much as I possibly can. Because imagine this, basically their incentives are perverse. What I mean by that is they don't want to do less than the indexes, or people will sell their mutual funds. They don't want to take the risk necessary to do greater than the indexes, because they might do less than the index instead. So they basically end up following the S&P 500 index, even though they promise you they're this or that or whatever, because their incentive is to get more money in the fund, because that's how they make money. They charge a percentage fee of the assets under management, right? And so they don't care what their performance is, as long as it's more or less equal to the market as a whole. That way people aren't going to run away from their fund, right? So the incentives and that's why most mutual funds over the past 30 years have underperformed the S&P 500 as an index, because not only are they trying to shoot for that index and maybe get close to it, but then they take their fees off, right? So their actual performance is a little bit less than the index. And so typically the way that's just because of the way they're incentivized. Their incentive is to get more and more money into their fund and not scare people out, so people leave their fund. So what would that do? They're not going to take oversized risks. They want to kind of make sure they're looking okay compared to all the other mutual funds out there, and they pretty much all behave the same.
Yeah, so basically I understand nearly all of what you are saying, but I mean, in our markets, it's different. I mean, all of those rates that you showed, like the interest rate and the unemployment rate, etc., etc. So what do you suggest? Switch markets to the US market? That would be great, but I don't think it's possible.
Well, I mean, it is possible. There's usually a way for you to find a brokerage firm where you can trade other countries as well as your own country, but I don't necessarily say you have to do that.
Yeah, so what
the
should I
advantage-
look for?
Yeah.
So what rates or indexes or should I look for to find like the golden gray?
Well, the ones that are generally tracking the US market are, like I said, the S&P 500 index or the NASDAQ 100 index are the two most commonly ones used to track the US market. There's many others, but those are the ones that, so you can look for either ETFs or mutual fund index funds that track those. I don't know what else to say. Sometimes you can get into a brokerage that would allow you to actually place orders on US markets, even though you're in Poland. And you have to look into that, depending on where you're in Poland. Maybe the laws may be totally different from country to country. So, but I would say you focus on what you know. And this is the Peter Lynch principle, right? It doesn't mean you can't make a really good investment return investing in companies do you know, because they're the companies that exist in Poland. And you can trade on the Polish market. So I'm not discouraging you from staying within Poland. You just develop your expertise so you know how to pick the best businesses that are going to do well that are available to you in Poland. All right. So that's why
basically I could also take a look at technological companies here, maybe even startup companies. So do you think that's a good idea?
Well, no, startup companies tend to a high rate of failure. Okay. Now, again, this is high risk, high reward, right? When you're talking about either startup companies that are public that you can invest in, or startup companies that are private that you have to give the money outside of the stock market. All right. Those are high risk, high reward. All right.
Yeah, because
most of them will fail and you'll lose your money. Some of them will succeed dramatically and make you a lot of money, but you just don't know which ones. So that's a very, very difficult area to succeed in. I don't encourage you to go to that point. You can make great success in larger, more successful, more established public traded companies that you have access to all the information. You can see what's going on and whatnot. These little startups, you don't have access to very much information. So
basically any index fund is better than like an individual company stock in the market, yes?
As a beginning investor, the best place you can start would be in some sort of an index fund. That's where now you've got exposure to the market. You can dollar cost average into that index fund. As you're learning, you can say, you know what, I'm learning more and more about this investing thing. I'm figuring out how to invest in individual businesses, and I really like this company. I want to own some shares of that. So then you can, buy some of that, right? Either with some new money coming in, you might buy that company's shares, or you might sell a little bit of your index fund and buy the company share. But don't do that until you know what you're doing.
Okay.
Because if you don't know what you're doing, you might as well throw darts at a dartboard, right? And just pick a stock, and you're just as likely to be successful or failure. But if you know what you're doing, you can really narrow down the universe to stocks that are much more likely to be successful. So that's what I would encourage you to do. Start off with an index fund, get exposure to the markets that way, and then learn. Take the time, learn more about how to pick out winning businesses. And when you can do that, now you can start evaluating their stocks and maybe investing in individual stocks.
Yes, nothing to add.
Okay, Charlie Munger.
The less sexier, the best, I think. Yeah. 90% of the members, new members, have to go into the index fund. That is also what Warren was saying, right?
Yeah, it's like if you are a new investor and you just put your money into an index fund, you're already ahead of the game. All right, you're already ahead of the game. You're in a small minority of people who are actually choosing where to invest their own money. Not a bad place to be. Now you learn, and you say, you know what, I can do better than this mutual fund or this index fund. I thought I should have bought NVIDIA. By gosh, it's up 140% this year. I should have done that, right? Right. So you can start identifying great businesses that you think have great future potential. And that's what we mean by long-term investing, right? Future being over the next 5 to 10 years. And then you can put your money there and allow all those employees of those businesses, all those smart guys in the executive suite, now they're working for you. You own the business. A little tiny piece of their business, but you own their business, right? All right. And so they're working for you. They're working to make you wealthy. That's a wonderful place to be. And Diego likes to use the analogy of a classroom of students, right? That you can buy the whole classroom and bet on all of them being successful in life. That's an index fund, right? And some of them will be successful. And so that will, overall, you'll probably do okay. Or you can look at their grades and say, I think this guy's going to be really successful. I'm betting on him and him, these three guys, or this and that lady there. Oh, that girl over there, right? Those 5, not all 30. Now you're investing in individual stocks. Right? And you're more likely to have success. So now you actually looked at their grades. You didn't say, I'm buying this whole classroom with 30 students. I'm buying only the best students. Or investing in them, you should say buy, but you're investing in them, right? So that's the difference. But start off by the classroom, by the index fund. You're likely to have some really good, successful students in that classroom. They're going to pull the rest of them along, right? Some of them will fail out and flop out and become unemployed or whatever, and not do so well, but some of them are going to do great. And that's the value of the index fund. Or you can say, take a little bit of time and say, let's go through these students' records. And this guy's outstanding. And these 4 others are really good, really awesome, potential. I'm going to invest in those 5 only.
And the funny part is that when you're trying to do it yourself or trying to pick the stock, look at the market every single day because you get worried about it, this and that, you try an error, you're actually spending a lot more time when you kind of learn, because it's a small gap that you need to understand what to do. But when I also was trying to learn in the first maybe 5 or 7 years, I was spending so much time but no progress, no growth. But when I go into deeper on that, I now spend way lesser time. So when you get to know what you need to do, which could be the 20-80 rule, then you can spend very less time and then to start this wonderful business. But the beginning is going to be a lot of time consuming if you go alone. But because we are going together, we are spending less time analyzing stock. We are learning from each other's insight as well as experience, and then doing the hands-on. That is going to shortcut all this kind of messy part, the complexity on the far side of the simplicity. So that is what you have to be going through if you go along. The complex thing, which could be decades, right? if you are not giving up along the way. Most of the people gave up because they're not doing well, right? But the thing is, same as the life book, same as your health and fitness or whatever. If you learn the methodology, you will get like, oh, I like this, I want to do more. And then you explore more about it. It's more intellectual stimulation when you go deeper and deeper. So there are a lot of potential to understanding about this investment, especially businesses, because after all, you're also running business. You are working for somebody else, or you have your own business. If you have the investor head that you know, oh, this is what the investor actually looking to consider to invest in my company or not. Oh, this is the thing that the market actually needs from me to do as a business owner in order to do better and go public or this and that. So the thing is the reward is huge, but the people don't want to put the feet on front of this door. So it's a consideration, but if you want to minimize your exposure on this war, but also grow at the 10% annual return, which is the index, actually it's 11.5 compounded with the dividend reinvested, then just start investing in the index funds, right? And maybe if you want to do a little bit more, you might have this kind of industrial ETF, which is the AI, the cloud, the security, cyber security, and there is plenty of things you can invest in the basket, right? And you don't need to pick one by one. So if that is the case, you just only buy the sector that you are familiar with. You know that it's going to grow in the next 10 years, 30 years and beyond, and then start investing small. So when you have the skin in the game, you will be able to have more confidence, learn more, adapt your emotional state as well, and keep growing. Because this is a journey. You're not going to get there without taking actions.
You can't think your way to wealth, no matter what the book says. Okay, you actually have to take action. Okay, so Diego is exactly right. There will be some learning curve. Now, Diego and I stumbled and fumbled and found our way through this to the point where now we're at that point where it's on the simplicity and the far side of complexity. That's the goal, right? We don't spend, neither one of us spends more than an hour a week doing our investing. That's it. It doesn't take much time, all right? But imagine Diego and I both came to the conclusion, if we had had a mentor and a group of people along moving through this learning process along with us, how much better and easier and faster that would have been, right? So many mistakes could have been avoided. So much anxiety could have been not there, right? And so much time could have been saved. And so that's why we do Wealth Angels. That's exactly, we want to teach you how to do this on your own, and we want you then to teach everyone around you. We want to see this ripple outward, right? Because there's absolutely no reason why everyone shouldn't be able to handle this. The markets exist to generate wealth, and there's no limit to the participants in the market. So hope you all take advantage of that.
Yes, so the last note, maybe we need to already go, but the ripple effect, right? Remember, we are doing this. If you think, yeah, you cannot do it, think about the next generations, because this mentality is passing on from generation to generations, right? Somebody needs to cut. I changed the family tree. I wanted to say that I need to take the responsibility to get it right. And then when I get it right, I'm able to pass on this knowledge, the wisdom, the experience to my kids, and making them take care of their money. And that is my biggest legacy, right? So when you reach your financial freedom, which I reached 3 years back, now I'm in contribution path. I want to grow, but I also contribute. I want the same for you, because everybody here in this call have a great heart goal. A great heart, right? And then we want to contribute. So when we get to the financial freedom, you will be able to actually focus on what really matters to you and not to others, and you are going to contribute to the society. But especially with your kids, or the grandkids, you are going to teach what you learn about finances. So if you think you are not enough, or you are fearful of success, or whatever it is, right? Think from that. They are enough. Are them enough or not? They're supposed to be living a good life or not? If you are getting right and your kids starting investing since teens or 20 years old, they will be able to get financially free at the 40 years old or even 30 years old. So can you give that gift? Can you pass on that gift to your kids? So think that way, long term. So it's not maybe for you, it's for them. But if you can take care of the church and learn in the proper way, you can pass on slowly to them as well. Because it's not what you say, it's what you do. They're going to pick up from you. Right, Joyce?
Yes,
I think
that's
Joyce
right.
also will agree with me on that, but I think it's possible. Okay, everything is in our head, in the mindset. If you change the mindset that you can do it, you will be right.
Yeah, this is why I say I invest with an infinite time frame. Right. I don't know how much years I've got left on this life. I've got a couple of daughters. I'm teaching them how to invest, right? So as I'm teaching them how to do this and they inherit whatever assets I have, they will be able to continue that legacy and continue investing, right? And they'll pass that knowledge on to the next generation or to institutions that they admire, or create their own great institutions to impact their community or the world or whatever. But there's no limitation on my time frame, even though I may only have a short time left on this earth, right? That's not the limitation of my investing time frame. My investing time frame has no limits. If you think that way, it changes how you approach this whole game. Okay. It allows you to be absolutely guaranteed to be a winner and not worry about trading short term, up, down, this, that. The longer your time frame, the more you know, the more guaranteed you are to be a long-term successful investor. It's not as hard as you think. Everyone, thank you for your time.
Thank you, everybody. Have a nice week ahead and start strong from November. See you there.
Thank you.
Bye.
Thank you.
Bye. Bye-bye.